Hi, everyone. Thanks for joining for another edition of our quarterly market update and quarterly economic update. For those of you that haven't had the chance to meet, my name is Nathan Davis, and I'm a partner here at Aspen and our chief investment officer. So I chair our investment committee where we make all of our asset allocation decisions and fund selections, as well as work a lot on policy and procedure for our investment policy statements, trading policies, things like that. So let me go ahead and get mine. That's pulled up here as well. Picture of the forest. All right. Well, what we're going to be talking about today, as always, we'll go through our equity and fixed income market updates, economic updates. We're going to change it up a little bit this quarter, and we're going to focus on a little bit of a deep dive on a specific asset class, mortgage-backed securities. Nothing specific about endorsements for them. They're just different. They're kind of unique. Figured it was a good opportunity to just provide some education on a little bit of a different asset class. And then, like we always do, we'll close it out with our implications for investors. You know, what do all of these things mean for asset allocation? What all these things mean for portfolio management? Overall as a high level of what we've experienced over the past quarter plus, second quarter with the majority of the month of July as well is, overall, despite some weakness at the headline level, underlying U.S. economic momentum has remained solid for the first half of the year. Same time, inflation progress that we've seen when inflation coming down has still been very slow. The labor market has continued its gradual normalization post-pandemic. All these things are kind of related to what originally occurred during the pandemic. Inflation's very much the same thing. Moving forward, resilient consumers should allow our U.S. economy to hopefully keep working towards a soft landing, bringing inflation down after raising interest rates and not avoiding a recession all at the same time. Hopefully resilient consumers can allow us to achieve that soft landing, into next year. But there's very much still some risks we'll cover as well. Anytime that there's uncertainty or tensions in the short term, we don't really believe in the long term, but in the short term, some of those things can very much cause some risks. Geopolitical tensions, upcoming elections that are always top of mind, very much things that are worth monitoring. When we look at inflation, it's forced the Federal Reserve to reassert its hawkish tone. We'll talk a lot more about that. They just met in June for the Federal Open Market Committee, and they updated their forecast for what the future would look like on potentially delivering one rate cut before the end of the year. Earlier in the year, they were projecting a lot more than that, and the 3 cuts by the end of the year. So they've changed their forecasts a little bit because of what inflation has been, with being a little sticky. Otherwise, we'll talk a little bit as well about other global central banks. There's a lot more to our global economy than just the Federal Reserve. But a lot of those other global central banks have begun to ease their policy. They've started lowering rates. And it's kind of created a gap. There's a gap that's widened in short-term interest rates here in the United States versus short-term interest rates everywhere else that has some interesting considerations we'll touch on. For markets, really, markets just continue to be great. It's very nice managing money during bull markets, but it just makes it really difficult to find things to talk about. Bonds started the year a little challenged, and they're doing much better. They've rebounded in the second quarter. Equities just have maintained. There's an upward trajectory for equities, and that has very much maintained. We continue to notch multiple new all-time highs, a little bit off that at the moment, just over the last 10 days or so, but continue to notch all-time highs in equity markets. And we'll talk about moving forward, earnings growth, broadening earnings growth. We've seen a lot of concentration, particularly in our U.S. stock market, with some big names, the Magnificent Seven, that everyone likes to talk about of what life looks like for the rest of the market going forward. And for investors, what do we want to use this information for? If we have an extended period of higher rates, if we lock in attractive yields and fixed income, talk about how it impacts cash, all of those things. So as a sneak peek of what we'll be talking about today, we're going to try and get through all of that. I do like to always remind people at the beginning of this is, we still have to keep all of this information that we're provided with on a daily basis keep it in the context of our investment philosophy, of your investment philosophy. For Aspen Wealth Management, our philosophy is a disciplined approach, regardless of market conditions. So whenever we're making changes, it's going to be systematic. It's not going to be emotional. We believe in being research-driven and grounded in academia for any decisions that we make. Globally diversified asset classes. A lot of markets exist outside the United States. We want to be aware of them. We want to be cost conscious. We don't want to be paying undue fees. We want to make sure if we're paying fees or realizing costs that there's a value to it. We believe in goals-based asset allocation. If we're engineering long-term success for a financial plan in a portfolio, it needs to be tied back to the goals of our clients. And then lastly, we have a dual risk mandate. We want to focus both on an investor's willingness to take risks, like their risk tolerance, how comfortable they are with volatility, and then also their ability to take risk as well, which is all determined as part of a comprehensive financial plan. And so we talk a lot about, hey, what have markets and economies, what have they done? What might they do in the future? We always like to just keep up with the times and see what's going on, but we're not making drastic changes on a day-to-day basis based off of what we think is going to happen. We always just like to be mindful of what could happen, how it could impact portfolios, and we review everything within the context of this investment philosophy here. Going into actual performance itself. So emerging market equity was the best performer for the quarter. All the numbers we're looking at here on the top half of the screen is second quarter performance only. Emerging markets were the best performers for the quarter, followed pretty closely by U.S. stocks as represented by the Russell 3000, the total U.S. stock market. We had international developed markets and global real estate slightly down for the quarter, and bonds were effectively neutral. Slightly up, as we always like to see green arrows, but 0.07% positive returns for U.S. bonds and 0.11% positive returns for the global bond market. Zooming out a little bit in terms of how the last quarter fits into the last 1 year, 5 years, and 10 years. So from a trailing 12 perspective, which is at the top for the last rolling 1 calendar year, all assets have exceeded their 5 and 10 year rolling averages in the last year. So when we're looking at U.S. stock performance of just over 23%, going down our line to left to right, international developed stock, emerging market stocks, there's a very clear trend when we look at these 1 year returns relative to 5 year and 10 year when we're looking in columns. And that is all of these asset classes have performed well above average the last year when compared to their 5 year averages and their 10 year averages. It's a good indication of what to look for ahead, particularly when we look at bonds here. When the 5 years relative to how we are for the 1 year, I think will be a good indication of the future looking more like what we've seen in the last year for bonds, as our current level of higher interest rates, as we get to benefit from it, the longer they stay where they are. Yes, we think that rates will be reduced here in the next 12 months, but that doesn't mean they'll be reduced back to zero where we had for many, many years. And so particularly for the bond market, the 5 year returns is a little bit of an outlier there. We think that the next couple of years will look a lot more like the last year has, if not slightly better. And then from an equity market perspective, we need to be mindful of how strong performance has been when all 1 year, 5 year, 10 years for the U.S. markets are beating their absolute long-term 100-year average return of about 10.5%. Even over the last 12 years, you're looking at about 1.5% per year for 10 years outperformance from U.S. stocks relative to their long-term average. Not everything has to revert back to a mean, but we want to be mindful of the fact that it's been a really strong couple of years, and we want to use that as a way to look into our asset allocation of the future. A little bit more of a deep dive into equity markets. As we mentioned, the all-time highs in equities, market segmentation has persisted, and relatively low volatility trend has continued. The last 10 days or so have disrupted that a little bit. Last I checked, yesterday versus today, we've had a little bit of a whipsaw. But overall, equities have maintained upward trajectory, and continue to notch those all-time highs. We'd like for that to continue through the end of the year. Moving forward, we're looking for broadening earnings growth, where more companies that make up these indices are contributing positively to earnings growth. And all of that should support a more inclusive stock market rally. Instead of just the top 7 versus the world, if we see a broader depth of strong earnings growth through the rest of our markets. And then with the low volatility trend, bull markets and low volatility tend to go hand in hand. When we have long sustained bull markets, it's not because we're getting 2% return days, 3%, 4% return days frequently. It's low 0.5% to 1.5% returns systematically over time. Kind of boring, but in a good way, because at least we're making money. But bull markets and low volatility tend to go hand in hand. You're not seeing very high returns frequently. In fact, you're not seeing them very often at all. And that's a very common component of bull markets overall. Getting into a little bit more of the details of how all this is working. So we're looking at some comparisons of the Magnificent Seven stocks, our Alphabet / Google, Apple, Microsoft, NVIDIA, Tesla, how all of these compare to the rest of the market. The resilience of the U.S. equity market in 24, it has been impressive with the returns that we've seen, especially considering the hawkish repricing in policy expectations with that inflation staying a little sticky. Everyone's trying to guess at what the Federal Reserve is going to do with it, thinking that rates were already going to be falling by this point in the year, and that benchmark just keeps getting pushed further and further out. But overall, stocks have showed very few signs of slowing. The S&P 500 is up about 15% this year. And that said, what we're looking at on the left side of our chart, the rally has remained narrow in nature. And those Mag 7 stocks continue to lead the charge higher, with providing a 34% return year to date, 57% share of returns overall, contribution to our index. Everything else other than those companies is netting at about a 7% return, averaged out together. So it continues to be narrow in nature. Cohort of stocks, which are here, up about 34%. The rest of the index is lagging that quite a bit. And it isn't without reason. So these companies were large beneficiaries of excitement around AI, artificial intelligence, and they really had the earnings growth in 2023 to back up some of these considerable rises in price that's led to this performance. And while that dynamic, the kind of excitement around how these companies can continue to grow their earnings, the dynamics continue to play out for the first half of the year, and as we've continued our earnings season to see what these companies are earning in Q1, and what we'll hopefully start seeing here from Q2 earnings. Other companies across other sectors are expected to see earnings that improve in the coming quarters as well. It's not just these 7 versus everyone else that's providing positive contributions to earnings in publicly traded companies. The breadth is really expected to improve over the coming quarters. So, as 2024 progresses, we're going to be keeping an eye on the depth of the market, how all of these other companies are doing as well, instead of just being driven by a select few. And we're looking into it, all that supporting a more inclusive, more sustainable equity market rally through the end of the year. Looking at the rest of the world for international evaluations, international earnings, as we talked about in some of the first performance slides, there's been a long cycle of U.S. equity market outperformance over international, over everything else. And it's left a lot of U.S.-based investors really nervous about allocating to the rest of the world. However, there's very attractive fundamental tailwinds around the world that are really difficult to ignore from an asset allocation standpoint. Sometimes it's way more difficult to not look at past performance and try and attribute it to future returns, even though that's the biggest disclaimer in investment management. sometimes it's really hard to not focus on past performance. But if we're just looking at where we are today, we're looking at those fundamental tailwinds for the rest of the world and using it to inform asset allocation decisions. Over half of the top 50 performing companies this year are located outside of the United States. We have said there's 7 companies that are outperforming everyone else, and everyone else is contributing slightly. But of the top 50 performing publicly traded companies this year, over half of them are located outside the United States. This slide aims to highlight opportunities that investors may be missing by not investing internationally at all or considerably underweighting their portfolio from an international perspective. At least that's where we are today looking forward. In terms of earnings growth, the U.S. has been standout up until this point. And right now, the prospects of other countries are improving. For example, there's been higher wage growth in Japan that could create a positive wage price spiral. It could boost company revenues. It could improve Japan's economy, which has been kind of sleepy for quite some time. Moreover, if we're looking at continued focus on improving corporate governance, running better companies, all of that could translate to generating additional multiple expansion. So the multiple of price to earnings that investors are willing to pay for these companies, as those multiples expand, it translates to higher prices, which translates to returns. All of these are factors today that seem like they're well set up to be realized in the future. Specifically in Europe, manufacturing activity is stabilizing. It's improving the overall economic backdrop, and all of that should translate to supporting earnings for companies. They're, kind of looking further out east, emerging. There's the peak pessimism towards China, which has been so volatile over the last 10 years of what China's actually going to do to contribute to our global economy. The peak pessimism seems to be behind us. And, emerging market earnings estimates have improved on the back of what can AI tailwinds do to help support emerging economies as well. And there really has. There's been an optimism for a turn in the electronic cycle to provide positive returns in emerging markets. And strong performance across international markets have pushed valuations higher over the last 6 months. They're lagging, but they're still being pushed higher. But in terms of both absolute terms and relative terms to their own histories, international markets continue to look attractively priced compared to the U.S. Looking at the actual earnings these companies have relative to the multiple of prices that investors are willing to pay today, very attractively priced, cheaper value abroad than we have in the United States, compared to some of the multiples that we see for our U.S. publicly traded companies. So, lastly, overall, can't just discount the importance of, given that some of the central banks, global central banks, other than the Federal Reserve, have begun to ease policy, meaning that they're starting to lower rates. They're starting to, acknowledge that their inflation is at the levels that they want to be. And the Fed remains on pause for that. So that translates directly to a strong U.S. dollar, could weigh on returns for U.S.-based investors. But there's still favorable valuations, improving economic backdrop, and very positive fundamentals, that all highlight plenty of opportunities around the globe. Definitely shouldn't just exclude these opportunities for your investment portfolio. Moving past equities, looking at our fixed income markets, interest rate volatility has persisted. We mentioned that in equity markets, there hasn't been a whole lot of volatility, but from the fixed income markets, from an interest rate perspective, there still has been. And a lot of that is just as the Fed continues to change their outlook on what rate cuts are going to look like, investors have to change their expectations again. As expectations change, it can lead to price volatility. Bonds overall rebounded after a challenging start to the year, but with rising rates early in the year, everything has started to rebound now. With the volatility intra-quarter, it was volatile, but when all is said and done, rates today are actually pretty similar to places they were to the start of the second quarter. So it's one of those things, just depending on how often you look at your bonds, how often you look at your account, It could make it seem like things are bad and could tell a bad story, but you zoom out enough, you look at the past almost 4 months, rates today are almost exactly where they were 4 months ago. Last thing here that we're going to make sure we're at the end of the hiking cycle. Investors may want to use this extended period of higher rates to lock in attractive yields in fixed income. We do still see a lot of investors that are in cash, that are in money market. It's really nice to collect 5% on a money market. It's really nice to collect 4+% on high yield savings. But as rates fall in the future, those will be the first things impacted. So, using this extended period of higher rates to maybe allocate towards things that are paying attractive yields for longer is a good consideration. Overall, taking all that to the Fed funds rate expectation, kind of draws all of these changes in the fixed income market and our bond market and how it translates to portfolios. The stalling progress on disinflation has forced the Federal Reserve to reassert what they call its hawkish tone, which means higher rates for longer. In recent months, while the Fed continues to have a bias towards easing policy, they acknowledge that they would like to ease rates, lower rates in the near term. They have been transparent with needing more evidence that inflation is trending in the right direction before they start cutting those rates. At its June meeting, the most recent meeting, rates were left unchanged. They decided not to cut, they decided not to raise. They left rates the same again. But what they did change was their forecast of the number of expected rate cuts in 2024. Previously, they've been indicating three planned cuts, 3 small cuts, likely 0.25%, 0.25% each time for 3 times. They did change that expectation to say that chances are there's only going to be 1 cut before the end of the year, at least with the information they had as of last month. In the updated projections, the committee increased its headline and core inflation forecasts up a little bit for the end of 2024. Thinking that things have stalled, and it is very possible that by the end of the year, inflation is even just a little bit, 20 basis points, 0.2% higher than it was expected to be in their earlier forecasts. Overall, though, they still are indicating they believe soft landing is possible. They still very much believe that the 2% inflation target is possible. It's just a slower, longer path to that 2%. Kind of looking ahead with the Fed, and what we can expect from them is they do meet again at the end of this month. Then again, 3 more times after that this year, mid-September, early November, and mid-December as well. So they change their forecasts and their expectations every now and then, just based off the information they have. But, moving forward with expectations that, Fed messaging will be very much in sync with market expectations, it would likely take, or it seems like it would take a meaningful change in the economic outlook to trigger a real sharp movement in long-term interest rates in the months ahead. It very much feels like we're in a holding pattern. What that translates to in terms of fixed income, bonds struggled the early 2024 as investors reconsidered the outlook for rate cuts. Overall, market and Fed expectations converged. We saw that a little bit on the last slide. Bonds have rebounded. Recent performance has stabilized. But overall, the higher rates have dramatically improved the income that's offered by fixed income. And investors now have a real extended opportunity to lock in higher yields. We've talked about this a few times in the past couple updates that we've done. What we're looking at with this slide is that, the broader fixed income market is made up of many smaller submarkets. You have U.S. Treasuries, you have municipalities, you have investment-grade corporate bonds, you have mortgage-backed securities, asset-backed securities. Then you have the rest of the world too, with, emerging markets, euros, everything else. And so this slide shows our yields across all of these various fixed income sectors relative to the last 10 years. And with our diamonds that represent current relative to the 10-year median of our purple lines, and then the range that rates have fluctuated over the same 10-year time frame. It's pretty clear trend across the board that not only are they trading from a yield perspective well above their 10-year median yields, but trading relatively near their range highs for most asset classes. Overall, you could get 5% yields relatively conservatively, which 5% is attractive, especially considering, post Great Financial Crisis, how hard it was to earn anything in any of our fixed income sectors. You can get 5% relatively conservatively, and then you can lean into riskier asset classes from a fixed income perspective into something like high yield, and get almost 8% from our fixed income. So it's an attractive environment right now for sure. While these bonds may not provide meaningful capital appreciation without a major shock, these tiny drops in interest rates that are being forecasted from the Fed are not likely to translate to capital gains, or at least meaningful capital gains in these positions. But we can collect really good income and should still help diversify portfolios, particularly if lower rates coincide with a recession. Doesn't seem like a recession is likely, but we will have a recession at some point again in the future. It just doesn't mean that it needs to be in the next year. All of these components of your portfolio really help provide diversity, especially if rates were lower in times of economic stress. And then, lastly, for all of these higher yields offer what we call a yield cushion, that helps offset losses if rates were to move in the other direction. If something were to drastically change, inflation starts ticking up, if the Fed starts losing control of that soft landing and inflation is going up and it appears that we're heading more towards a recession, they start raising their rates. What you would lose from a price perspective if rates were to rise is considerably smaller than what you would make if rates were to fall or hold constant. There's a cushion there, and it provides the potential for asymmetric returns, which are always a good thing to find in the investment world. They don't happen often, they don't last forever, but the yields where they are today, and if we looked at the likelihood of are rates going to rise or are rates going to fall, and if they did either of those things, to what degree would they rise, to what degree would they fall, it's very clear that purchasing any of these assets today provides an asymmetric return profile that if rates were to fall, which is the more likely scenario, you have the potential to make a lot more than you could lose if things were to change and rates were to continue to rise. So we use that to kind of go into mortgage-backed securities. And this is by no means a endorsement of mortgage-backed securities, and you need to put all your fixed income in mortgage-backed securities, as much as it is, hey, we talked about all of these various sectors that we have within fixed income. I would say that Treasury is pretty easy for people to understand. Hey, you lend the U.S. government money, they pay you back. Pretty strong credit rating for the U.S. government. They print their own money. Chances are they're going to be able to pay you back. And mortgage-backed securities, is just for general education, they're just pretty different from the rest of the bond world. A mortgage-backed security is a type of investment that is backed by a pool of underlying mortgages. People understand mortgages because chances are you have one or you've had one in the past. The primary bond benchmark, the Bloomberg Barclays US Agg, consists of about 25% mortgage-backed securities. That is a market cap-ish weighted index where they look at all of the debt that is issued in the United States, and that index wants to weight according to the outstanding debt. So about 25% of outstanding debt is all of these mortgages that are consolidated and pulled together in these mortgage-backed securities. Within the benchmark, mortgage-backed securities are second only to treasuries. U.S. government debt is about 44% of that benchmark. And then mortgage-backed securities are relatively equal to corporate debt. We hear a lot more about corporate debt than we do mortgage bonds. Corporate debt, in all of its aggregate, is pretty close to 25% of that index as well. Agency-backed mortgage bonds are most common. you'll hear these three government agencies that are generally referred to as Ginnie Mae, Fannie Mae, Freddie Mac. They have much longer, traditional government agency names, but all of those are kind of based off their rough acronyms of the three main agencies that guarantee these loans. And we'll talk about that a little bit more in the next slide as well. But why mortgage backs are so different, and some of the key differences from traditional bonds, is that as homeowners make their monthly mortgage payments, those payments then go into the mortgage-backed security, and mortgage-backed security then passes that through back on to investors. And so traditional bonds pay you interest while you hold them and then return principal at maturity. But as all of you know from when you make your own mortgage payments, it is a principal and interest payment. And as a mortgage-backed security owner, you receive it in the exact same way. It is payment of principal and interest every time you receive it, with no final return of principal at maturity. And so as opposed to fixed rate bonds, the payments you receive can fluctuate. You don't always necessarily receive the same payment each month once all of these things are aggregated together, because it's dependent on borrower activity. As you also know, as mortgage owners, you have the ability to refinance. You can move, and you need to get a new mortgage with your new house. All of these borrower activities can change how the payments fluctuate, which brings us to our last 2 points here, which are unique risks for mortgage-backed securities compared to most treasuries, compared to most corporate bonds, in that they have prepayment risk. As rates fall, borrowers choose to stay in their homes, but refinance their loans, get a new loan, get it at a lower rate. And when borrowers refinance, the principal is returned when a new mortgage is issued. But this new component of your bond is issued. It's reinvested at a lower rate. Borrowers are getting rid of their old higher rate mortgages and they're taking on a lower rate one. That is a unique risk for mortgage-backed securities. In direct opposition to that, on the flip side, is extension risk. When you enter into a mortgage-backed security investment, there's very much an estimate of the pricing of what are rates going to do in the future, and approximately how many of these mortgage owners would refinance, or on average, how many people move and turn over their mortgages. And so when you're determining an actual yield to maturity, maturity is a little bit of a sliding scale. And so on the other end of prepayment risk, there's extension risk as well. More similar to the environment we've been in the last year, where as rates rise, there tends to be a low volume of new mortgages because it's largely just for people who are moving, for new home buyers. Nobody is staying in their home and choosing to take or replace their mortgage with one that has a higher rate. So as rates rise, there's a low volume of new mortgages. And it can take longer as an investor to receive your principal back if those rates stay high, longer than was anticipated when the bond was originally packaged up. Today, it seems like prepayment risk seems a little bit low. Homeowners are locked in at historically low interest rates. Only about 10% of borrowers would have an incentive to refi, even if rates fell from 1% to 2% from here. But tying all of that into investment considerations for why do these fit into a fixed income portfolio, into a bond market portfolio, there is a spread that's paid above U.S. Treasury rates. So the yield advantage is what non-Treasury investments offer in terms of coupons and yields above the comparable Treasury. It's called the spread. It is usually meant to compensate the investor for additional risks, like credit risk. Credit risk is the risk of default. If I could lend money to the U.S. government versus lending money to any corporation, I would expect the corporation to pay me a little bit more because they have a chance of going out of business, where the U.S. government is very unlikely to default, and they could always print their own money to pay you back anyways, even if that would wreak havoc on our economy. And so there's a spread involved to compensate investors for credit risk. The same thing applies to mortgage-backed securities.
Hey, Nathan, On that note, one of the guests had a question. Mortgage-backed securities are what got us into this mess a decade ago. How are mortgage-backed securities different today than they maybe were prior to the Big Short and things like that?
Yeah, great question. And so a lot of it is the quality of the mortgages themselves that go into these. When the mortgages that were being offered and effectively sold leading up to the great financial crisis, there was a lot of times no requirement for borrowers to have an income. They didn't have to have a job. They were calling them ninja loans, no income, no job. That they could still borrow money to buy a house just because they were trying to increase volume for it. The oversight of those loans back then was nothing compared to what it has been today with all of the problems that were discovered through the great financial crisis. And so the requirements to qualify for these agency loans that go into these investment grade portfolios is that these are borrowers that have a job, have an income, are limited in what amount of that income can go towards servicing their mortgage debt. There's a higher requirement for down payments than there have been in the past. You can't take a loan for 100% of a home's value, because if that home falls in value and you lose your job and you can't pay, you see significant losses come through to the mortgage bonds. So all of those things that were previously an issue with mortgages have all been since corrected. At least for mortgage originators, they learned from their mistakes. And then the other component of it with the great financial crisis was the root issue was all of those very terrible loans. But everyone took those very terrible loans and said, hey, if there's 1,000 of these terrible loans, like, again, all default. And then financial institutions were effectively betting with each other on, I'll give you a certain amount of money if that does fail because it's so unlikely anyways. And so one mortgage bond blowing up for the great financial crisis would then also blow up a vehicle that had two financial institutions betting against each other on whether or not it would blow up. And you were looking at all of these different investment vehicles that would create a chain reaction, that one mortgage bond's default would put three different institutions in trouble. All of that has been very much corrected as well. But great question. Qualified borrowers, a lot more regulation, which in this instance has been good, very much changes mortgage-backed securities relative to where they were at the great financial crisis. But so expanding on that, the spread that we get from mortgage-backed securities is what yield is being paid above similar treasuries. But with agency mortgage-backed securities, which you generally see in your investment-grade portfolios, the credit risk is very low. Because one of the agencies has an explicit backing from the United States government, and the other two have implicit backing of the United States government, meaning that if there's defaults on any of these loans, the U.S. government is willing to make the lenders whole because of it. And the reason they're willing to do that is because of all of the requirements and restrictions that have been put in place on that lending. So the default risk is very low relative to a company that can, have a lawsuit or a couple of years of mismanagement and can go bankrupt, and the credit risk exists there for any other bondholders. These pay more than treasuries and also have very similar backing to treasuries in that they are explicitly or implicitly backed by the U.S. government. And so with mortgage-backed securities, continuing with our investment considerations, the risk is less about whether you get your money back, but when you will get your money back. So as we said, if there's prepayment risk, there's extension risk of, we don't know how many mortgage borrowers are going to refinance or not refinance, and you can always change that time frame. So the issue is more about when you will get your money back, since it's paid down principal and interest over time. So what this is not a great asset for, specifically, is for anything with a defined obligation. If you are funding a home purchase or an investment property or college for your kids, and that it, without a doubt, you're going to need that money in 2 years, probably should not use a mortgage-backed security for that, because you don't know when you will get your money back always. Prices have fallen to a point where yields are near 5%. So as we said, it's better than treasuries are paying. And for investors who have been hesitant to move out of short-term investments, because your money markets, your high yield savings are paying 4% or paying 5% now. In light of rates potentially falling in the future, you don't have to give up much yield in order to actually extend out the length of that yield that you would get when you consider something like mortgage-backed securities. They're paying very similar amounts to what most of the short-term yields are paying today. And so overall, kind of closing it back out, prepayment risk is low. A very small percent of borrowers would have an incentive to refinance if rates fell. Prices have come down quite a bit, that even as rates continue to adjust in the future, it's a good opportunity to effectively lock in, 5% rates, as including this as part of your portfolio, big part of the benchmark anyways, but particularly for investors that are kind of hesitant to move out of those money markets. You need an incentive to move on. This is a part of a fixed income portfolio that very much needs to be considered. So moving past our fixed income and our deep dive on mortgage backs, just for our general economic update, we've had some weakness at the headline level. Momentum underlying has remained solid. There's been some pros and cons. Progress on inflation has been slow. Labor market continues to normalize. Inflation and labor market both dramatically impacted by the pandemic, and we've just been seeking normalization ever since. Global central banks have begun easing, lowering their rates overall. We talked about that a little in fixed income. We'll talk about it a little bit here too. But overall, so at the first glance, the U.S. economy appeared to slow during the first quarter. Real GDP fell from 3.4% annualized the fourth quarter of last year to just over 1%. But if we strip out some of the more volatile components, that would be net exports, there would be inventories. If we strip out some of those volatile components, the underlying momentum for the economy still looks solid. The U.S. economy should maintain soft landing into 2025. Something would have to drastically change in order for that to be reconsidered. I mean, really on paper, everything is looking great. Consumers have displayed impressive strength, supported by the tight labor market. There should be more jobs than there are people looking for them. And so that even if they're not ideal jobs, having jobs available keeps us from the worst of a recession. And all those positives to be said, but there's very much some signs of stress. It's not all butterflies and roses. Sentiment still remains suppressed, even if things are going well. People just don't feel like they're going well, and they don't have a positive outlook for the future. Spending on non-durable goods has slowed. Americans love to spend their money. They always will, but the rate at which they're spending has slowed. That translates through to our economy quite a bit. And then lower income households, there have been mounting signs of stress. Auto loans, credit card loans, delinquencies have risen, not only to pandemic levels, but above pre-pandemic levels. Something that needs to be monitored. But overall, a tight labor market, real wages are rising. Those should continue to offset those dwindling excess savings, the tighter credit conditions. Consumers should help extend the economic expansion into next year. Overall, looks like we're going to maintain a soft landing. We're on trajectory for that. The upcoming U.S. election in the short term, we don't believe that it impacts markets. We don't believe that it impacts the economy. But it is uncertainty, and uncertainty can be a risk overall. Higher policy rates, if they have to stay longer for higher for longer, is a potential risk. Geopolitical tension, always going to be a risk, but plenty of risks remain that we're going to be mindful of, that we would need to see something change with all of these risks in order for it to change our overall aggregate outlook for the future. Because overall, the outlook looks pretty strong for U.S. economy, at least in the short term. Inflation was kind of the core of all of this. It's why inflation got high. It's why the Fed had to start raising the rates to begin with. We've made meaningful progress towards the Fed's target of 2%. That progress has stalled in 2024. we're looking at our chart here, things got really high June, July 2022. We saw a really good 12 months of noticeable improvements. And then as you can see, kind of into the tail end of 2023 to where we are today, all those numbers are pretty flat. So we've stalled our progress. We've remained kind of range bound between 3.1, 3.5% since last October. So the journey to 2% may take longer than expected, but there's still disinflationary forces that, are going to allow inflation to resume its downward path. So even if we've been stuck for these past, 9 and 10 months, there's very much forces at play that give us hope that we can get to that. We can kind of push through this stall. We can get to the 2%. Core goods prices are one of those things. They've continued to trend lower in 2024. Supply chains have remained well managed, that, overcoming the scars of the disruptions that we saw during the pandemic, all of those supply chain disruptions. The more volatile components, which are usually energy prices have rebounded in recent months due to higher gasoline prices. That's been part of the reason we've been stuck. They were lower for quite a bit there, and then they rebounded and started moving higher. Food inflation has been actually kind of mild. That hasn't been an overweight contributor to inflation. Food prices have been relatively neutral. And moving forward, all of the slowing global demand, really kind of limits the likelihood of a surge in either of these categories. So it seems like they shouldn't be as problematic going forward as they've necessarily been in the recent past. And so it brings us to what do exist today and in the near term as the stickier segments of inflation. It's been shelter, it's been auto insurance. Shelter inflation accounts for over a third of the total CPI basket, and very much has held stubbornly above pre-pandemic trends. The measure just for shelter has grown 0.4% or above month to month for 7 consecutive months. And so, that indicates itself like on an annual basis, just under 5% annualized for inflation. But, shelter inflation should start to follow real-time measures of market rent back to more normal levels. And in the not posted, but kind of the preview data, it does seem like rents are normalizing and coming down a little bit, or at least not rising as fast as they had been. So that's looking promising for getting us over this stall. Auto insurance is very expensive. It's been another source of hot inflation, currently rising by over 20% year over year. And, fortunately, these prices, they fell on a monthly basis in May. So seemingly they were starting a trend of correcting that 20% year over year rise in auto insurance. It's improving. It's not worsening, at least with the near-term data that we have on it. As the rollover in vehicle and auto prices start to kind of feed through the data, the trend lower should only just continue. Overall, inflation should continue to ease through the balance of this year, through the remainder of 24 into 25. The ride down may take longer than anticipated, but the Fed should feel reasonably confident that inflation can get to or very, very close to the 2% target that they've set. Hopefully by the middle of next year, without needing further policy tightening. They shouldn't have to raise rates anymore to get us very close to that target. Labor market, as we said, it's normalized post-pandemic. Job growth remains solid for the first half of 2024. Unemployment rate edged up to 4% in May. It did mark, at that point in time, the 30th consecutive month of unemployment at or below 4%. That's the longest streak of low unemployment since the late 60s. I say had marked the 30th consecutive month because as of last week, it must be adjusted back down, I guess. But the initial posting for unemployment last week was 4.1%. So we've ended the 30 consecutive month stretch of at or below 4% unemployment. Still not a concerning rise. Structurally, it's going to be very difficult for unemployment to get to levels that it's been at in the past, 6%, 7%, even with some economic strife, just because so many baby boomers have left the workforce. Our workforce is smaller now than it had been in the past. As all of those baby boomers continue into the retirement years, that subset of the labor force has a much lower participation rate than we had in the pre-pandemic, which is just to be expected. But participation amongst non-baby boomers, so working age 18 to 64, has very much fully recovered to pre-pandemic levels. It's recovered from those pandemic losses, and the age 18 to 64 segment of the workforce has very much returned back to normal from a participation standpoint. And then lastly, we'll just touch on, there's a lot of economies globally that matter outside of just the United States. I always like charts like these because you just know that green is good and yellow is okay, and you want to avoid the red where you can, and you just look at it and indicate, hey, we've been on a pretty good trend from where we were during the pandemic. Overall, it seems like things are improving. We're not able to really get down into the details of it, but after a somewhat sluggish ending to 2023, the prospects for global economy appear to be turning a corner so far in 24. Countries that have done well, like the U.S., include India. We should continue to do so. Up until the end of last year, the economies that have lagged, like Europe, should see better times ahead. The economic surprises, so whenever actual data has come in different from expectations, leading to, surprises in data, those surprises have largely been positive ones in recent months for Europe. And so there's probably too much pessimism towards the region currently if expectations are that low and they continue to surprise to the high side. Seems like pessimism is a little bit too high. There's good opportunities for growth there. And, activity that, can be supported by higher consumer confidence. We have rising real wages there. There's stabilizing manufacturing activity. So as expectations and realities start to converge on the fact that there's a lot of positives in our global economy, it will continue to translate to good returns, particularly in markets. China has a real estate slump that's kind of continued to slow their growth. Activities gained momentum in recent months. There's incoming data on employment and inflation that looks a little weak over there. But, all in all, fiscal support is that they provide, they prop up their own markets, they prop up their own economy. But it's going to focus on housing. It's going to focus on growth, and that growth should stabilize around 5%, well below trend for China. But, better than it has been in the near term. Elsewhere in Asia, Taiwan, Korea, they're going to benefit from renewed global demand for tech products, all of that AI enthusiasm for two very tech-heavy economies. They have more favorable demographics than they've had in the past. They've had positive economic reforms. All of that should continue to feed momentum there, and similarly in places like India. Overall, this year should mark a turning point for the global economy. And while the recovery may not be across, all countries, brighter times very much seem to be ahead for many countries, for many economies. U.S. consumer activity, it's expected to slow. We're going to see some narrowing growth. But, overall, it should highlight plenty of attractive opportunities domestically, and then across global markets as well. We'll wrap it up as we always do with just general themes as pertains to portfolio management, asset allocation, and implications for investors. For being honest, these haven't changed, and they haven't changed in almost a year now, but I still believe in them, so I will still continue to tell you them. Our continued themes are that it started with inflation, it ends with inflation. All of the changes that we've seen in markets and our economy since the pandemic has been about controlling inflation. It's why rates started rising to begin with. We're going to very much focus on when inflation gets back to target, because that's what started all of this. That's what we'll end it as well. With our fixed income, we want to review allocations that we have in fixed incomes to make sure that we're broadly diversified. We want to look at terms. So what amounts we have in short-term bonds, mid-term bonds, long-term bonds. We want to look at credit qualities, as we talked about. U.S. government treasuries are as high quality as it can get, because it's backed by U.S. dollars, and U.S. being able to print their own money or return it to you as an investor. You can look at mortgages that have slightly different credit qualities from treasuries, or at least they pay different amounts for, slightly different credit qualities. Corporations and their bonds, all of these different sectors of fixed income. We want to review our portfolio to see how we're allocated across all these sectors. And then for equities, review our allocations for high quality companies, great cash flows, great balance sheets, low debt. We want to look at our exposure to the top 10, that top Magnificent Seven, to see are you overexposed? Are you adequately exposed? Or are you underexposed to those companies, which may have been a little bit of a drag the past 2 years, but may provide quite a bit of risk management going forward? And then, looking at our developed international exposure as well. We talked about a lot of opportunities for value in developed international markets relative to what we see here in the United States. All of these tie in to our implications for investors. We still want to make sure that we're avoiding common mistakes. We don't want to time the market. We don't want to focus on the headlines and all the short-term noise that occurs that would lead us to making a change to our long-term plans or our long-term strategies. And we don't want to just chase past performance. When we're investing with something, it needs to be a balance of what's occurred in the past and why it occurred, where things stand today and what opportunities there are for the future. We don't want to simply chase past performance. We want to maintain a systematic approach. All-time highs, we continue to hit them, and that's great. Really love that as an investment manager. We don't have any control over it, and those all-time highs are no reason to make a change. It's not a reason to not invest. It's not a reason to cash out. All-time highs happen all the time, so we want to maintain a systematic approach that leads us to sell for a reason, to maintain risk in our portfolio, not just because markets are at all-time highs at any point. And then the last implication that we have is to just have a plan for your cash. We keep getting closer and closer to rates falling. The cash, the money market, the short-term CDs, all of those are vehicles that are really attractive yields today, but they're also the most subject to falling and the greatest reinvestment risk as they mature. If rates were to fall in the future, you have to reinvest those proceeds at lower rates. So just have a plan for your cash. You own cash, own it for a reason, as an emergency fund to fund a short-term purchase, anything like that. And whatever excess cash you have relative to that, come up with a plan for putting it back to work. So that is the conclusion of our presentation for today. I was very excited to get a question. It's been many quarters since I actually got a question from someone, so I really appreciate the question. And please reach out to us if after this is done, if it's something that's personal to your finances, personal to your portfolio or situation. Please reach out to us for more information. Let us know your questions. We're here to help. We work as a whole team here. So even if your direct contact with Aspen is someone who is not me, we really love working as an ensemble. All advisors here want to know all of our clients. We're here to help. Please just reach out to us if you want more information, if you have any questions, if there's anything we can do to help.
Hey, Nathan, we do get one question if you got a minute.
Yeah.
There's one from Joel in the chat. The global tech outage caused by CrowdStrike software obviously disrupted business operations. While many have, I'm just going to read it verbatim, while many have now resumed business as usual, we continue to learn more about the potential impacts and costs of the event. Do you see any implications, maybe in how it pertains to portfolios, things like that?
It's a really good question. And if we're being honest, I don't have an answer for him.
Yeah.
No, I don't. I can get him an answer. I don't have an answer to it today. The closest thing to an answer is It's kind of similar to what we do here at Aspen. Is from a due diligence perspective, not only as an investor but as a due diligence perspective as a business owner, is being mindful of kind of concentrations to different service providers and partners that you have, and being mindful of diversification of who's providing your IT services, who's providing your tech solutions. I do think it's going to be a good reminder for a lot of companies to reevaluate those relationships to try and avoid something like it. But yeah, I have no idea off the top of my head what implications it'll have for publicly traded companies, what implications it'll have for markets going forward. But I'm happy to look into it and provide a perspective on it here, Sam.
Yeah, Joel, I'll circle back to you with Nathan on that, but thank you for asking that question. I really appreciate it.
Yeah, thanks, Joel. Anything else, Jim?
No, that's great. I didn't know if we'd wait for another question too, but thank you guys so much for taking the time, and thank you, Nathan, again for. I know you put a ton of work into these presentations, and it means a lot. This will be available as well via YouTube, so if you missed this today, we'll have it available as a recording. Normally it takes us a couple days to kind of get that cut and turned around, but you'll see this available in YouTube form, and it'll be sent as an email to you once it is available. So thank you all for attending today.
Yeah, thank you.